My name is David Buckland, and in this week's video insight entitled The 18 Weeks to 4 November 2019 and Hobson's Choice, I thought it appropriate to take stock and discuss how markets have performed since 30 June, particularly in the context of the very big positive moves in the June 2019 half year. The larger markets, including the US S&P 500 and the Nasdaq, the Japanese Nikkei 225, the German Dax 30 and the French CAC 40 are all up by an average of well over 5% since June 30. Other markets like the Australian All Ordinaries, the UK FTSE 100, the Shanghai Composite and the Hang Seng are all lagging by comparison. Each of these latter markets have special factors, including pressure on the banking sector in Australia, Brexit issues in the UK, the trade war leading to softer Chinese consumer demand, and Hong Kong protests shrinking that economy by 3.2% in the September 2019 quarter. The big shift, however, continues to be significantly lower interest rates. After increasing their cash rate 9 times at 0.25% each, over the 2016 to 2018 period to 2.5%, the US Federal Reserve has gone into reverse, cutting 3 times in the past 3 months by 0.25% each to the current 1.5 to 1.75%. Philip Lowe, Governor of the Reserve Bank of Australia, has been fearful of a rising Australian dollar, and he's also reacted by cutting the Australian cash rate on 3 occasions in the past 5 months, also at 0.25% each, to the current 0.75%. Over the calendar 2019 year, US 10-year Treasury bonds have come down by nearly 1% to 1.78%, while the Australian 10-year government bonds have come down by well over 1% to 1.18%. What do these record low interest rates achieve? In Australia, cash rates averaged 6% in the 2 decades leading up to the global financial crisis. And 10 years later, they are at a record low 0.75 of 1%. The big issue I see is the pressure being placed on the retiree generation. They can generally choose 3 paths. 1, to eat into their capital. 2, to cut at their expenditure. Or 3, to travel up the risk curve by investing a greater portion of their investable funds in risk assets. For many retirees, this must feel like Hobson's choice. And central bankers must realise that the record low interest rates experiment is not having the desired effect across their broad economies, but with many powerful structural headwinds, including record indebtedness to GDP, like Hobson, they probably have little choice as well. Thanks for following us, and please continue to follow us on Facebook and Twitter.